Like we've talked before, there's a lot of jargon in our industry. And one of the terms that comes out a lot is debt to income ratio when we're talking about lending and lenders. Can you explain exactly what that means and why it's important to a prospective buyer?
Yeah, DTI for short. It's one of the most important factors that we look at when qualifying a buyer. And what exactly it is after we run your credit, we see your monthly liabilities that pop up on a credit report. We don't really care about things like your cell phone bill or your utilities, stuff like that. We care about, your credit cards, your student loans, your house payment, your car payment, those kind of things that show up on a credit report, right? So we take your minimum monthly payment for all those things. We don't care as much about the balance. We're looking at the minimum monthly payments. We add all those up and we add your proposed monthly payment for your new house, and we divide that by your monthly gross income. And that gives us a percentage. For a conventional, we want to see that below 46% generally. And for an FHA, we want to see that below 55% generally. So that combined with credit are the two most important factors when applying for a mortgage.
You mentioned that you're not as concerned about utilities and cell phone bills. Is that just because that's just a cost of living? Everyone has it?
It's a cost of living and it just doesn't pop up on your credit report. The only things that we care about that don't pop out on your credit report would be things like child support payments. Those don't really pop up on your credit report, but we do have to include those if you pay child support. And if you don't tell us that up front, we'll find out eventually. So it pays to be completely honest with your lender up front.